Let's bring in Adrian Mowat, who is now joining us. He's emerging equity market strategist. Adrian, great to have you with us here. Thank you very much. Even from the last time that we spoke, which was not very long ago, things have turned quite dramatically southwards, especially in the US and a little bit here in India as well. How are things looking to you and how things changed? The big event, I think in the intervening period from the last time we spoke has been what's happened in the UK, but I don't know how much global impact is there because of that. Your thoughts?
Yeah, so when I was last on, I was, of the view that we should be adding a bit of risk, and clearly I've got that wrong with the decline in the markets that we've seen. So we tested the sort of 200-day moving average back in the middle of August, and the markets then started to sell off. And we've had a period of extremely hawkish statements from the Federal Reserve and some other central banks as well. And I think the markets are quite unnerved by the Federal Reserve. I think a Fed that just talks about data is not doing its job properly. We all know that monetary policy has a lag. You should look at the data because it tells you where you are, but it doesn't tell you where you're going. And so what we've got is capital markets pricing in an over-tightening, an accident, a hard landing. But we've also now, and you brought up the Bank of England, got financial problems emerging. So the British pension fund industry in extreme stress. Look at the decline that we've seen in gilts. If you bought a gilt in 2011, you've made no money over that time period with the sell-off that we've seen today. So we have a significant financial stress there. And I think we're going to see financial stress in other institutions, in other areas beyond the United Kingdom. And so the next stage, I think, is central banks being as sensible as the Bank of England and starting to look a little bit more at financial markets and financial stresses and do their job. And part of their job is not just inflation. Their job is financial stability. And I would really commend what the Bank of England did. And I'm very sort of frustrated with the Fed, who just seem to be singularly focused on inflation. They're not thinking ahead about just how much monetary tightening is going on in the United States. Okay, we talk about the Fed fund target rate, but let's have a look at what's happened in capital markets, how much those have declined. We've got a record high dollar index, that's significant monetary tightening. We also have quantitative tightening going on as well. This is a huge amount of tightening, and you can see the collapse in monetary aggregates. And I think the Fed is just totally overdoing it. And so the markets decline, and then you get the reflexivity of financial institutions getting into stress, which causes more selling.
No, you very nicely kind of sort of put, Adrian. But, we got people investing rates like Stanley Druckenmiller, etc., who've made this point repeatedly, very recently on the network, on CNBC in the US, that the basic fault was that they were late by a year, the Fed, in terms of, they were still doing full-on QE and printing when retail sales, for example, had gone back above pre-COVID levels, right? So they were very slow to respond. So now they have to act and act aggressively. What's the way out, really, if not this?
See, I find, what Stanley Druckenmiller said, just extraordinary, because where was he in the end of 2021? Was he not aware that South Africa had sequenced the Omicron variant for COVID? We at the end of last year, it was quite possible that this pandemic was going to get seriously worse than it had been. We were fortunate that a lot of people were vaccinated. We were fortunate the Omicron variant was not as severe as previous variants. It would have been totally inappropriate for central banks to be raising rates towards the end of last year. And even in the first quarter, it wasn't clear that we would be able to exit the COVID crisis. So I think it's foolish just to say, oh, they were too late, they're 1 year too late. It's total hindsight behavior. So, okay, they were sensibly considering that issue around the Omicron outbreak and the big increase in the number of positive cases. Now, we then had Russia invading Ukraine, which pushes up energy prices.
Although
as you say,
to be fair, he did write a Wall Street Journal op-ed, I think, back in early 2021, urging, saying that, well, you must, the central bank has now got to kind of put a stop to this. So, I mean, he may be wrong, and that's your opinion, but the fact is that he did point it out back then. So, I mean, he's not saying this now; he's been saying this for a year, for a year and a half.
Fair enough.
Sorry,
but we can't deny the fact that there was the Omicron variant. We can't deny the fact that the number of cases was rising rapidly, and countries are putting in place flight bans, and there was a lot of potential damage to the economy going on there. We can. I think the mistake that we're making here is actually this transitory story. A lot of the inflation pressures at the moment are transitory. People talk about the tightness in the US labor market, but if you look at the non-farm payroll, in the total number is exactly the same as it was entering the pandemic. So we've really just re-employed those people. And we're just in that period where at a micro level, there are all these dislocations, but in a dynamic economy like the United States, those dislocations will be resolved. And so I think we're overreacting to the headline inflation rate and not thinking enough about the recent history and what has caused this inflation.
Hindsight is...
Because I go back to, we all love to sort of talk about monetary aggregates driving inflation, but we've had a long period of things like QE and there wasn't much inflation. What we've had is the most dramatic dislocation to the global economy that I've ever seen, courtesy of this pandemic.
Hindsight is 20/20, right, Adrian? So everyone with the benefit of that can have the opinion. But Adrian, you've tracked Indian market for so long. The whole debate last month was decoupling, whether the market's going through some kind of decoupling or not. That's been thrown out of the window, and how in the last 1 week. But even then, our market, Indian market, is still relatively outperforming, both in the currency market and in equity markets. What have you made of that, and do you think this outperformance can sustain, or maybe even can become more pronounced?
Well, your fundamentals are better than other major economies. Your inflation problem is better. You've got no growth problem at the moment, very high economic growth. And that's then reflected in less concern about earnings than we're seeing in other major markets. So I think India can continue to outperform, but it's likely to be an outperformance in whatever direction the global markets are going. And at the moment, it's falling less than other markets.
Okay, it is falling less than other markets. We have run out of time, but not out of questions. Adrian, always a pleasure speaking to you. Thanks a lot for joining us. The big event, of course, today will be the RBI policy decision. A CNBC-TV18 poll indicates that a majority